Well, it's time for...
This is Hit My Portfolio. Hit My Portfolio.
That's right. It is that part of the episode where we bring in an expert and a community member to get their portfolio pimped. And we have in the studio with us Luke Laretive from Seneca. Luke, how are you?
Bryce, Alec, how are you?
Good.
And we have Sally. Sally, welcome to Equity Mates.
Yeah, thanks, guys. Excited to be here.
Well, thank you so much for submitting. So, Ren, to kick things off, what have we got in Sally's portfolio?
Yeah, so Sally's portfolio is made up of 10 stocks, the largest weighting being BHP at 28% of the portfolio. After that, we've got Commonwealth Bank at 14%. The smallest weighting, to give you an idea of position size, is Woodside at 3%. So nothing smaller than 3%. I reckon Luke's going to like that. But some of the other stocks that are in the portfolio, Australian Foundation Investment, Flight Centre, James Hardie, NAB, Origin, Westpac and Webjet. So some big Aussie names in that portfolio. Luke.
Right.
So as we always like to start, we like to get a nickname and then Sally will ask you how this portfolio came to be. But Luke, what have you got nickname-wise?
All right, this one's called Grandma's Greatest Hits.
Wow, Sally, how do you respond to that?
That cuts deep, mate. That cuts deep.
All right, well, Sally, before Luke keeps talking, how has your portfolio come to
Sorry,
be?
Sally, I'm sorry.
Listen, no, it's all good, mate. Listen, to be honest, it's sheer dumb luck. I think I got, that, and you're dead right. Got some old school advice somewhere. Oh, if you're going to invest in shares, BHP.
Yep.
Most of these have been a one-off. Have just been cash I've thrown at them. A couple with the banks and the Webjet, stuff like that. Was COVID. I saw them just hit rock bottom and I went, they've got to improve from here. And yeah. Just, I don't know, just every now and then I dabble in them and then I pick one that's good. The JHX, the James Hardie, was pretty much the only one that I actually kind of did a bit of research in.
Nice.
Got them at a good price and they've done well. So, they might be grandma's picks, but I think I've done all right.
That's all that
That's what
matters.
we like to hear.
If grandma's making bank, everyone's happy.
Nice. All right, Luke, well, with that context in mind, what are your initial thoughts?
Okay, so let's just go through the stuff I own, and that's pretty much just saying I think it's good and you can own it and it's worth holding. We'll talk about portfolio weights and stuff in a sec. So we own BHP. We're underweight though, so that's kind of like a sell from us. We kind of have to manage the index because we're trying to beat it. We just bought James Hardie recently, so we like that. We're super high conviction Webjet. You can, if you Google Luke Laretive and Webjet, you'll find lots of stuff about.
You say pumping the stock.
Yeah, about my thesis on Webjet and why I like it. We covered in the Seneca YouTube quarterly thing, and we've got some Westpac as well floating around. So outside of those four, I've got 27 other companies in the ASX 200 that I'd rather own than the stuff in your portfolio. So that's my thoughts on the stocks in a quick 10 seconds. In terms of building a portfolio of direct shares, I know, BHP and CBA seem safe or whatever, but you shouldn't really buy anything more than 10, maybe 15 if you really want to get aggressive percent of your portfolio in a single stock. So, maybe just keep that in mind. I think 1 or 2% as the bottom weight is fine, and then the stuff in the middle should be like 3s, 4s, 5s, 6s, 7s. That's sort of how you should do it if you want to build, run your own direct portfolio. But to be fair, it doesn't sound like you want to. Sounds like you're just sort of throwing darts at the dartboard and hoping something sort of sticks and stays.
Pretty much.
Yeah, and look, that's like a lot of people. So, don't feel bad. Like, what's better than what you've done is running a proper process. What's worse is doing nothing. So I think the fact that you've made a start, you're saving your money, like you're trying to invest in stuff that's going to do well for you. You're thinking about, investing in household names, stuff that hopefully you at least have some concept of what they do. Like, it's not all bad. I sort of come in here sometimes and get a bit like wacky with the stick, and it's, it's not necessarily all negative. That being said, I did want to use this as an opportunity to talk about AFI in particular. So, and I want to talk about listed investment companies in particular, because for all the grandma portfolios out there, they are all full of listed investment companies, whether it's WAM, AFI, Mirrabooka, Argo, there's lots. They are not a good way to invest your money. And I can categorically say that.
Oh, look, you're preaching to the choir here with Bryce. It's a gripe of his for years.
So they are businesses that are an active manager. So just think of it, there's no difference paying me, you're just paying Jeff Wilson or whoever. And these businesses, instead of buying $100 worth of shares and getting $100 worth of shares, you get some number higher or lower, depending, whether it's trading at a discount or a premium. Further to that, these managers have what I call trapped capital. So, you give them $100 to manage, and they take that $100 and invest it in shares. If you want to sell $50 worth of shares, they don't sell $50 worth of shares. You sell your $50 worth of units to somebody who wants to buy into that portfolio. So that means the fund manager, when they do poorly and everybody wants to sort of get out of that fund, all of a sudden you're trading your units at a steep discount to fair value, because everyone wants to get out, and vice versa. When they're doing well, everyone wants to get in. You've got to pay a premium. And so to me, when you've got an open-ended version of the same sort of products,
which is an ETF.
An ETF or an active manager, normal fund manager, anywhere, me, an SMA like what I run, you punish the fund manager by taking your money off them, and their fees go down. You incentivize the manager to get you good returns by giving them more money, and their fees go up that they earn. In these LIC structures, there's no incentive to do the right thing by investors. So as a result, their returns are absolutely rubbish. And I went and had a look at the top 10 ETFs, listed investment companies on the ASX. There's $25 billion tied up in these listed investment companies, and all but one of them over the last 12 months has underperformed. All but one of them over the last 6 months has underperformed the Vanguard Australian Shares ETF, and over 10 years, one beat it by 28 basis points. So next to nothing. Now, you'd be doing much better than both of those things if you were in one of my products. Now, I can bang on about my products till the end of time, as you guys know, but we'll save that for another day. But my point here is that if you can get into an active fund where a manager's got a good process, charges a fair fee for a fair service that they deliver, that's great. If you don't want to do that and you want to buy an ETF, go and buy an ASX 200 or ASX 300 following index ETF for, how much are they? I don't even know these
0.04 is the cheapest.
4 or 5 basis points, and you're going to be getting it for 1/6 of the price of AFI. And now, Sally, you've only got a small percentage of your portfolio in AFI, but I just wanted to use this as an opportunity to educate the audience more broadly about listed investment companies. And for you, Sally, something that you could think about is, over time, new contributions, just choosing a broad-based index ETF or an active manager if you want help doing that. The reality is that that's going to get you a share portfolio without you having to guess, and you're probably going to get better returns than you scattergunning and crossing your fingers and hoping it comes back in 20 years and it's all gone well.
Yeah, I think...
Rant over.
I think to echo something that Luke was saying there, Sally, is because a lot of your positions are some of the bigger Australian companies, BHP, the banks, it does sort of look like some of the bigger companies in a ASX 200 or ASX 300 ETF. So have you thought about ETFs as part of your portfolio?
Yeah, listen, and only recently I've kind of jumped back on the bandwagon of, doing a bit of research and obviously listening to you guys a fair bit and, reading Morningstar and so on and so forth. And I'm not overly savvy with this stuff, but ETFs have been something that I want to kind of get into and have been considering. And I have been kind of considering selling a lot of that stock that I've got now anyway. Exactly as what you guys said, I think a lot of it's kind of outdated and it's kind of hit its max, and it's time to kind of get out of there and maybe use those funds to then invest elsewhere.
Yeah, nice.
Yeah, I think the Beta Shares A200 and the Vanguard Australian Shares ETF, they're probably two good products to do a bit of research on. And they have similar names to what you've got there.
Is there an iShares version as well? Surely
there is IOZ.
There you go.
There you go. For the sake of completeness.
Yeah, it's completeness.
Yeah.
So I think a few takeaways here, some winners.
Correct answers here. Come on, mate, lift your game.
According to Luke, a couple of winners in here at the moment: Webjet, James Hardy.
We like Webjet.
Keep that in there.
Like that.
Some COVID stocks. But I think overall, if you are to consolidate and sell off a few, there's the opportunity to reallocate into broad-based ASX ETF and pretty much get very similar exposure to what you have already.
Or a lovely active manager.
Nice.
But Sally, I think what Luke said earlier is the biggest takeaway from this. For everyone who comes on to Pimp My Portfolio, and for Bryce and I, there's always things we can be doing better. But the fact that you've started and the fact that you're in the market is so much better than not getting started at all. So well done on your journey to date, and hopefully we've given you some thought starters for the next steps.
Yeah, absolutely. Thanks heaps, guys. It's you pretty much kind of just reconfirmed my thought processes in some of those aspects as well. And like I said, ETFs were kind of on the card and on the list, and I'll definitely be looking a bit heavier into that.
Nice. Well, thank you for submitting today. We really appreciate you doing that and then coming on and sharing your experience with the audience as well. So, Sally, all the best with it. Thank you so much.
Thanks, Sally.
Thanks, Sally.
Thanks, guys. Thanks for having me. Thanks for the info.
Now, if you'd like to submit to Pimp My Portfolio or would like to get in touch with Luke or any of the other advisors in our network, head to equitymates.com/advice and we'll make sure we put you in touch.
Equity Mates! I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.